Imagine taking off a whole year to travel the country with your family. Twice, today's guests use real estate investing to do just that. Hello, passive investors. Welcome to Passive Pockets, the passive real estate investing show. I'm your host, Jim Pfeifer. Today, I'm talking with passive investor Mark Kelley, who has parlayed capital from a successful career as an IT executive into passive real estate investing across the Southeast. We'll discuss why he transitioned from an early single-family portfolio into passive investing, how he learned to always vet the operator, and we'll get into what he learned from his best and his worst deals along the way. Here's my conversation with Mark. Mark, thanks for coming on the show.
Thank you for having me, Jim.
Yeah, so today I want to spend most of our time and most of our conversation focused on your passive investing, but let's start at the beginning. Can you share with the audience a little bit of your backstory and how you first got into real estate?
Sure. I first got into real estate in 2009. It's a pretty depressed time in the housing market. There were not a whole lot of buyers. My wife and I had just gotten married. We were about 26 years old, and we bought our first home. And in buying that home, there's a little bit of a story where we did not have the money for a down payment. So instead of having a wedding, we worked with her father, who had planned to pay for the wedding, to get the money for the down payment. And so that was the start of our journey in real estate.
Oh, wow. Okay. So that was your first real estate, but you lived there. When did you get into real estate as an investment? So
that first home kind of exposed me to the opportunity to make money with real estate, because even as a young married couple, we now had a 3-bedroom, 2-bath house, and we rented out one of the bedrooms. So did a little bit of house hacking to start to get a little bit of cash flowing from a home that we had. As we continued to live there, we were really focused on building up our income through our day jobs, and we actually purchased our first rental property in 2014.
When you decided to rent out a room, can you talk a little bit about how that came about? Was it that you needed to do that, or you just came up with the idea, hey, let's get a roommate and make some extra cash?
Actually, we purchased the home and the mortgage was a little bit uncomfortable for us. It was a very safe debt to income ratio, but the mortgage was more than the rent that we were paying. So we decided to get a roommate to get a little bit of extra cash.
Interesting, because that's before the days, where house hacking became a thing. So it's interesting you got into it there. Is that what led you then to think, oh, wow, I have this asset that I live in and I can make money off of it. Maybe real estate is something I want to do. And is that what led you to then kind of expand your active real estate?
It is. So during that time, we had that home. We did not necessarily have our sights set on becoming real estate investors. We were really focused on just good financial habits and getting a household started. But eventually, when we moved up to a bigger house because we were having children, we converted that first home into a rental. And that was about the time, actually, that we purchased the home that I mentioned in 2014, giving us 2 rental properties. So it did set that all in motion. But it took a little while for us to get our heads wrapped around even having enough money that we could make another investment in real estate.
Yeah, that's interesting because it parallels my story a little bit, where in 2008, we built a new house for our growing family and couldn't sell the old one, so we turned into accidental landlords. And that's where I got the bug, where I saw what the asset was doing, and I thought, wow, I need more of these. So I started buying up single-family homes. So can you talk about your journey? So now you have a couple of rental properties. Where do you go from there?
We've covered from 2009 to about 2014. And during those 5 years, it was really about getting our incomes up. So it's important to mention that during this time, I moved out of the construction industry. My wife moved out of the kind of copy and printer industry. We both got into IT. We got our incomes up. And so from there, we're now managing 2 rental properties that are here in Raleigh, where I live. And then we have our home. And things are just kind of plugging along until we actually decided to take a year off in 2016. We took a sabbatical, in part because we had developed a small real estate portfolio. We had paid down some debt. We had started to realize that the cash flows could help support us. And so at that point, actually, we took a little bit of time off to travel with our young kids. That was 2016.
You had jobs and you kind of just said, we're going to put that on the side now, buy a motorhome and travel around living off of our real estate.
That's almost exactly right. Real estate covered about 50% of our monthly spend on that trip.
That's fantastic. I mean, these are some of the reasons why people get into real estate, right? You could get into real estate to eliminate your W-2 altogether, or you could along the way enjoy it, right? And allow real estate to do something like allow you to take a sabbatical. And I think that's one of the powerful things about real estate that's different. If you're just shoving money into your retirement account, your 401k, you're not going to be able to take that sabbatical. So real estate is really what propelled you to be able to do that kind of neat thing with your family.
Absolutely. Real estate had a huge part in enabling us to do that. And we saw the opportunity to take that trip, and we did. Our investments in real estate, just to clarify our intentions, it's not to retire early. It's not necessarily to develop enough cash that we don't have to work. We're very deliberate in our careers, and we continue to build our careers while also building a real estate portfolio and another, a more diversified investment portfolio.
That's fantastic. I love that. So now we have a couple of real estate investments. You went on the trip, you come back. Did you keep investing in real estate?
Actually, no. We had about a 4-year run between 2017 and 2022 where we sold the investment properties, but also had a tremendous run in our careers. We made, frankly, all sorts of cash through various ways in our day jobs in the technology industry. And so we got rid of these single family homes. We actually took the proceeds of those single family homes that we had as rentals and bought a beach house fully paid for because we wanted a place that we could take our family and go and give the kids some memories. But heading into that 22 time period, although we didn't have any single family rentals, it was about that time that we discovered passive investing. And that's where we made the move out of active over those few years, ending up with a lot of liquidity, and moved into passive investing.
Okay, so how did you find passive investing? And also, what do you mean by passive investing? Because when I was an active real estate owner and had my properties, I thought I was passive because I was hiring a property manager. So passive investing, I've found, is completely different than what I was doing. So when you say you transitioned to passive investing, what was that for you, and how did you find that as an investment?
With passive investing, for us, I mentioned we took the year off in 2016. We also took the year off in 2022. And when we were out traveling the world, which is something that we aim to do every so often, we're not in a position to be at all involved in the properties that we have, back at home or wherever we have invested. So when I think about passive investing, I do think about places that I could deploy capital. I can make that initial decision. And then I can sit back and have somebody else, work on generating the cash flows and generating the appreciation of the capital that's invested.
I mean, that makes sense. That sounds like syndication investing. So how did you educate yourself about this new investing style or option? How did you get information and make decisions?
Bigger Pockets has been a part of this whole journey. And when I did find myself with a fair amount of liquidity to invest, I turned to Bigger Pockets to figure out where to invest. And I considered a lot of options. I considered buying huge swaths of land. That turned out to be not a good idea. I thought about buying, even some single family homes and just getting a manager involved. But I discovered Brian Burke's book, The Hands-Off Investor. And that book kind of opened me up to this world that I wasn't really clear existed, or maybe I knew it existed, but did not think that it was accessible to me. And with that book, it did give me the confidence to go out and make some investments in syndications.
That book is phenomenal. It's one of the few that I have that's dog-eared and scribbled in and reread a number of different times. So how did that work for you? Meaning, did you then go out and look for multifamily operators? Because that book has everything you need in it to invest in a deal, but it doesn't give you names of operators or syndications to go look for. So how did you take that next step?
This actually was certainly an interesting journey to find out the opportunity, to find the opportunities to invest in. It's a bit of a closed network. I decided that I was going to network here where I live in Raleigh, North Carolina, to find the operators that were already trusted by people that I looked up to or had a reputation as being savvy business folks. And it took a lot of time and a lot of calls. And I had a lot of dead ends as I was looking for these opportunities. And then eventually I did find several operators to potentially invest in. And just to kind of catch everybody up, in that year, I deployed, $1 million into maybe 8 syndications with 4 different operators.
Wow. So I'd like to talk about that a little bit because at Passive Pockets, that's one of the things that we help people do is just to find their people, right? Find a community, find contacts that can help you recommend, hey, here's an operator that I like. How did you find in Raleigh these operators through, or the people that would then recommend the operators? Because trust transfers, right? If I know somebody in my community who I know, like, and trust, and they invest with an operator and they tell me, hey, they're good to go, then I feel a little bit more comfortable. I still do all my own due diligence. But how did you travel that with finding your first few operators through people that you had just met and they recommend someone to you? How did you get comfortable?
I ended up networking with personal connections and professional connections here. And as I met folks who made these types of investments, they tended to be the ones who were kind of helping organize reputable LPs, like to be a part of an investment. And so one of the ways that I would try to vet this as somebody that doesn't have much knowledge of, multifamily, that only knows about what I read out of the book and then the other research that I could get done, I looked for who's investing, who are some of the other LPs that are investing, have they invested with that operator before? And a lot of my attention was put on trying to develop some sort of level of confidence in the operator and then the deal secondarily, as is outlined in the Hands-Off Investor book.
So tell us about that first syndication. I remember, like, the first time I sent a wire, that was just terrifying. Like, is it going to get there and all of that? So talk about how you found the operator, how'd the deal go, any details you could share.
Sure. So the first one is not a deal that has gone full cycle yet. I have had several go full cycle, but that first deal was a $200,000 investment in a value add, business plan for a multifamily complex where it's not a high rise. It's a place where every unit has a front door. Maybe the garden style is maybe what folks call it. Is roughly an $18 million purchase. There was obviously equity being raised for that deal. The folks who were investing, it turns out were kind of a who's who of local business folks here in the Triangle. I was very comfortable with some of the folks who I had heard were going to be a part of this deal. And the person that had kind of brought me into the network was also going to be a part of the deal. So I invested $200,000 into that deal. And that would have been kind of roughly 2021 timeframe. That property has had some challenges, as I've had others in my portfolio, which I look forward to talking a little bit about that experience. But, that $200,000 decision, frankly, was a 1 hour decision, from having better understood who the GP was, knowing the folks that were investing. I was happy to make that investment. And doing the wire transfer, it was my first time, and it was a little bit clunky. I was very nervous and warned that fraud happens all the time. And the bank told me that, I got to know who's on the other end of the line or I'm going to lose my money. But I got my head wrapped around that and was happy to make the investment.
I mean, that's a big investment for your first one too, right? You didn't dip your toe in. You were all in. And it's interesting because there's, different people do it different ways. And I think you were really relying on the expertise of others and knowing that, hey, these well-respected people in my community are jumping into this, so I'm kind of going in with them. Is that kind of how you did it?
Yeah, it is, and I learn by doing. That may sound crazy. I will like to clarify that while I did invest what is a lot of money to me, it is not an amount of money that would ruin me if it didn't come back and if I made some hugely egregious, mistake. But I saw that there were a lot of tire kickers in this space, and actually, pulling the trigger is something that's hard to do. It did take a little bit of courage to overcome, making that first investment. But it was also important to me that, after I had spent months and months networking to figure out with whom I was going to invest, that when that opportunity came forward that met the criteria, I set the emotion aside and I made the decision to invest.
Yeah, and I think the critical thing, you said it there, right, is it wasn't an amount that if it went bye-bye, you're still able to feed the family, right? And that's critical. And that number is different for every family, every person. So, the key is to make sure that these investments work for you and not against you. And you mentioned some challenges. What was the main learning point that you got from this first deal, Mark?
So this deal was about 3 years ago. And I would say the main thing that I learned, after all of the craziness has happened in the multifamily world, is that these syndications do not always go to plan. This deal will be fine, but it is going to be a situation in which I thought my money might have been there for 2 to 3 years, and it could be there more like 5 to 7 years. So illiquidity is real, and that is something that I learned from this first deal. The money has not come back to me, and it may not for a few years.
That's just such an excellent point and a great thing to learn, especially when you start in this, if you like 2018, 19, and 20, they'd say a deal would go 5 years and it would only go 2 or 3 and you double your money. And so that's the expectation. But what you really have to expect is it might go 7 years and you have to be prepared for that, right? And so when you're thinking, hey, I'm going to invest an amount, you got to think I'm not going to be getting that back for a longer time than it might say in the pro forma as protection. So that was deal one. You kept going, right? You said you invested in several other deals. So can you talk about just a few of the next syndications you invested in?
Sure. So there were additional kind of individual deals. Now there is one of these syndications was a fund. So there's 4 operators that I've invested with. 3 are I'm investing in the deal directly, but 1 has been a fund. And that's been a very interesting experience because there's been a lot of challenges that have happened within the fund, but there's also been a number of wins that have happened. And it showed me that a fund is a path to potentially mitigating some of the risks that are real when it comes to investing in syndications.
So let's talk about what a fund is, right? Normally, the first deal you did was a syndication. So it was a single deal. It was an asset that they went and bought, and you put your 200 grand in there, and then you share in the results. A fund is, and there's a couple different kinds of funds, but basically a fund is usually a blind fund where you will say, okay, here's my cash, go invest it, and they will give you maybe a box. They'll say, hey, well, we're planning to invest in multifamily, 200 unit buildings in, North Carolina or something like that. So that then you don't know the individual investments, but they're going to go and buy a bunch of different properties and put them in the fund. Is that what your fund was like?
That's exactly right. And it was a U.S. Southeast focused fund. And it did check some of the boxes that you mentioned, a couple of hundred units per investment. I invested $250,000. The fund was advertising maybe a 12 to 14% IRR. And that $250,000 was invested across, maybe 6 to 8 different properties.
And so you mentioned there were some good things that happened and there are some challenges. Let's jump in. What are some of the good things that happened?
Yes, one of the good things that happened is that as the fund was raising its round, which is they were raising a very large sum of money, they started to transact deals like before the round had closed. And so I came in towards the tail end, and that gave me an opportunity to see what had already happened before, to see some of the deals that had been purchased. And keep in mind, I did not just invest directly talking to the fund. Again, I followed some much smarter people than me who have been doing this for decades into that deal. In fact, they kind of got me access to it. But because we could see some of the early activity of the fund, we saw that there were kind of gains right out of the gate. And so it was great to establish an early lead with that fund where you build up a big lead in the first half. So that was all good. But then there were a number of setbacks within the fund that, harmed individual properties. And so, for example, one of the properties was in Atlanta and got caught up in kind of all of the backlog of evictions that has really kind of bogged down that Atlanta market. And that deal, the fund saw really no way out of it except to transact it for, pennies on the invested dollar. That deal was a loss, but it was a loss which did not offset the early gains or some of the well-performing properties within the portfolio. So if I had just picked that Atlanta deal, I would have lost all of my money. But being in a fund where there's some diversification in different ways, that helped balance out those challenges. One property had a fire. Another was recently impacted by Hurricane Helene, a property that was heading to market. So things happen. I've had individual properties get impacted in different ways. But in this fund, I think the important thing for me to realize is that there is an ability for a portfolio manager to manage risk with a diversified and set of investment properties.
Would that be how you would lean going forward? You'd prefer the fund, or do you prefer the single asset? Because the fund, you had some losers and some winners, and so it averages out that you're going to be okay, where an individual deal, it is what it is.
Yeah, actually, I would lean more towards the individual properties. I have more of a kind of an entrepreneurial spirit and, want to see a chance for a slightly higher return. And so, the fund feels a little bit more like clipping coupons, and I don't think that that's the way that I would go in the future. But I've now had that experience and know that maybe that's not for me.
Well, let's talk a little bit now about, like, you're in a number of deals. Is there one that is outperformed all the others, and maybe on the, sorry to say, the downside, is there one that you're like, oh, I wish I hadn't done that one?
So within that fund, actually, there was one that dramatically outperformed all the others, and this is with a firm that has been managing real estate and real estate investments for more than 75 years. One of their first transactions blew the doors off of any IRR that they had ever realized. It was an anomaly in a lot of ways and set a record for them in terms of, the IRR for an investment. So that was great. And then I had an individual property that, again, like you mentioned, was marketed in the offering memorandum on a 5-year pro forma, and it returned like 1.7x on the capital invested in 12 months and 2 weeks. It was very quick that they were able to turn that property around and sell it just after the 1-year period, which has tax implications. And that was tremendous. So kind of early on, I saw a lot of wins, and I will say that was on the way up to some of the challenges that have impacted some of the other properties that I have. There is one that is exceptional in its difficulty, that is a conversion of a hotel into efficiency apartments. I knew that was going to be risky. Everybody else investing knew that it was going to be risky. I would say it was even more risky than any of us had correctly anticipated. And we were all very happy to put our money into it at the beginning. But there were permitting issues with the city. There were construction issues. A lot of it tied back to electrical systems and the kind of ovens that you could put into these units. A lot of this, frankly, could have been discovered with maybe sharper due diligence during the planning phase by the GP. But whether that could have happened or not, the end result is that this project, which was a construction project, not generating any cash, frankly, went off the rails and had to be put back on the rails. And there were 2 capital calls as a part of this deal. And I had invested $100,000, and the first capital call was for about $7,000 or $8,000 to bridge a gap. Then there was another capital call that was for $33,000. So I ended up $140,000 into the deal. And I think the key thing here, going back to the trust of the LPs, this project got into trouble. The GP doing all that they could to get this thing to completion, and they just ran out of runway and had too many bad breaks, frankly, along the way. The GP came back to the LP group seeking these funds. If we had had a weaker LP group, the LPs may not have come up with that additional capital. And those are pretty big checks to cut, when somebody's coming back, somewhat unexpectedly because we're in these dire situations. But this is where I did learn a valuable lesson, which is to invest alongside a strong LP group. This goes back to my original way of evaluating the deals. And the LP group, there was a lot of LP to LP chatter. As I mentioned, there's a lot of folks in the community that are a part of this group. And we decided that we would all pony up the money and provide this loan to the property to get it through. And we have. The property is now more than 90% occupied, and we're going to own it for years longer than we expected to make the money back. But we had to rescue that deal.
When things started to go bad on that deal, did you feel like the operator, you said a little bit due diligence, do you think the operator, was this an experienced conversion operator? Because, these conversion deals look fabulous because you're taking an old rundown motel and you're converting it to apartments, probably workforce housing because there's undersupply of that everywhere. And so it just sounds fantastic. And if you have an operator who knows what they're doing, it can be fantastic. So would you say those troubles were the operator, or was it other issues?
A bit of both. This was the first conversion for this particular operator and for, the LPs involved, and it'll probably be the last. And I've chatted with the operator about it. I mean, it's been tough. It has been, but it came with all sorts of curveballs that were regulatory that I don't know that anybody could have foreseen coming, including delays in inspections as a result of the pandemic, supply chain issues. Like there were many compounding factors out of the control of any individual or team.
Yeah, and one of the things I've learned the hard way, harder than it sounds like this deal is going to pan out eventually. The first time I did it was, someone was really good at one thing and then they switched to something else. They went from single family homes to office. And I thought, well, of course, it's real estate. They're going to be great. And they weren't. And I lost money. It was terrible. And I decided I'm never going to be someone's guinea pig. But that's something that you learn along the way. What I would like to ask for this is, you talked to the other LPs, and it was good that you had a strong group of LPs. What were the discussions that led to, we're going to participate in this capital call? Because there's a lot of people right now that are dealing with capital calls, which is where the operator says, we need more money to be able to get this deal across the line, but it's an underperforming deal. So you have to decide, do I have enough faith? I already put $100,000 in here. Now I'm asked to put 40 more. Is it throwing good money after bad, right? So how did you guys decide, you know what? Yep, we're gonna do this and see it through?
That's interesting because there were some of the discussions that were, you could tell some folks were madder than others, and some folks felt like the problem should have been foreseen. I would say that the reason that folks reinvested is one, like to rescue a local project, two, to kind of give ourselves a shot at getting the money back, which did make sense based on like reforecasted projections of what the property could accomplish. We do believe in like the mission of the property. We believe in the area that the property is located. We believe that it meets an unmet need in the market. And there was overwhelming participation from the LP group to step up. And, we all ended up contributing 40% more than we had originally set out to contribute. And an overwhelming, chunk of the LPs participated. I would say, if I had to guess, more than 90% of the LPs participated, and then some other folks filled in the gaps for others that maybe weren't in a position to help. But it's a critical lesson that I learned. If that had been a weak LP group, we would have been handing the keys back. Most likely, my investment and everybody's investment would have been gone through foreclosure or through some sort of punitive outside financing that came in and swept all of the upside off the table.
How do you control for that? How do you know going in that you have a strong LP group? I mean, I think you have an advantage because you have a local kind of group there that maybe invests together. But as you move forward and expand your investing, that's not really something that's easy to know going in, right? And so how do you deal with that going forward?
I mean, that's where it does continue to be a bit of a networking game and investing in operators that, for example, have a 75-year track record of operating and they have a brand. They're in the community or they are visible in the communities where they work. I do not ever plan to invest, in a syndication upstart. To the best of my ability, I will try to avoid that. I try to gravitate towards established track records and to syndicators that have built a brand and need to keep it intact to continue to build their business.
Now, just talk about some of the lessons you've learned generally from the syndication investments you've made. You mentioned a few things, but maybe to someone that's new to syndication investing and just getting into it, what are some lessons you'd like to share with the listeners?
The biggest lesson is that once you put the money into the syndication, you do lose all control. Everybody says that, once you put it in, you've got to be comfortable with somebody else managing it and carrying out the business plan, but also like the spirit of this is to be passive and to not be emotionally attached or have to deal with the stress or to ride the highs and the lows. And so, for folks that do make these investments, I think they need to have the right mentality that they're making an investment and it could be years and years in the making. And they're just planting a seed for the future and they can't kind of have to keep coming back and wondering about, the performance. They should check in quarterly, not turn a blind eye. But I do see some folks get kind of wrapped up in, what's going to happen. And that, it would be a shame for a passive investment to be a stress-inducing event. So that's more philosophical, I would say. But it also leads to the point that, don't make these investments if you do want the control, if you want the flexibility on getting the money out, or if you're working on a timeline where you have to have the money back, like all of that is a recipe for pain and stress.
Yeah, no, that's great advice. I do want to touch on, before we look to the future, I want to touch on diversification. How do you look at diversification? I'm sure you have other investments, and this is one part of it. But as far as under the real estate bubble, right? How do you diversify, or is that something you think about?
It is something that I think about, and I think it was in Brian Burke's book where he defined, diversification as not having a single point of failure. Yeah, I abide by that, and I think about all of the different angles that could require for diversification. So, for example, I invest with 4 different operators on the off chance that one of them turns out to be, totally inept, or worst case, some sort of scoundrel. So I diversify with operators. I do stay focused in multifamily because it's an asset class that I understand. I don't branch out too far from that. But I do think about geography. I think about how much I put in each syndication. I made that first investment of $200,000. In retrospect, I probably should have pared that down to like 100 and, maybe done kind of 10 exactly at 100 instead of a few at 50 and then one at 200 and another at 250 and then a bunch at 100. Because of course, it's the $50,000 ones that are turning back over and returning my money, but then it's the $200,000 one that's locked up for another few years, just the way it's going to go. So I do think about diversification, and these investments in my overall portfolio are, a measurable percentage, but in no ways is our passive investments in real estate the thing that I am like riding into the future.
And I think the way you said it there made me think that I think diversification is very personal, right? I talk a lot about diversifying by operator, by asset class, and by location, and a few other ways. But I think it's also very important to diversify only to the point that you're comfortable, right? If you're not comfortable with other asset classes, then just diversify within what you're doing. So I think that was really well said there. Now, as you look to 2025 in the future, talk about your real estate goals, and are you still doing the syndication thing?
So I do intend to continue to invest in syndications, but I have branched out in real estate and started to get into single family home development. This is also a passive investment where I'm working with a builder and a contractor that's managing the whole process, and he's procuring the land and running the crews and getting the houses built and sold. But I've turned to this because in syndications, like deals are down. Even some deals that are coming along, like the avenues that I used to invest through, it's not as easy to get money together from an LP group to go execute on a syndication. So I've diversified and looked back to single family homes as a place where there's high demand, not enough supply, building costs have come down. And so I am sponsoring some spec home development, mostly entirely passive, just providing the finance to the developer.
As you go forward and you think about what you've done already in syndication investing and what you've learned, like let's say the market gets better and there's more opportunities in syndications coming up, because I believe that is how things will shape up. You kind of started as a follow the leader, right? You're finding really smart people who know what they're doing, and you're just jumping on and saying, I'm with you, which I think is a great strategy. Has what you've learned enabled you to maybe get beyond that and do more of your analysis yourself, or are you still piggybacking, or a combination of both? Because both are valid strategies, obviously.
Yeah, I'm still piggybacking. And to clarify, I have no ambitions to ever become a GP or to try to run one of these deals. My strong suit is not in financial analysis and doing the due diligence necessary to really evaluate a deal. I will continue to follow smarter people into the deals. And also in an LP group, I want to be the lower man on the totem pole, meaning I want folks in there that have more at stake, who are bigger names, who are wealthier individuals, who, if things go wrong, there's kind of more than one avenue to potentially, rescue a deal. And so I am happy to follow smarter people into deals who are doing the due diligence, who really care about the details. But also, the last thing I want to be is like the big fish in the LP group.
Yeah, and I think that's interesting, an interesting way to look at it, because one of the first deals I had that didn't go so well, I only had $25,000 in it, but unfortunately I also got my dad and my sister in it, so we had a little bit more, but there were people that had $500,000 and $1 million in the deal. So when something goes wrong and there's a fight to be had, those people are much more likely to step up to the front, to spend the money on attorneys and do the fight. And then you can be like, hey, I'll just tag along. So I think that's, you have to know your own strategy, right? You have to understand where you fit in. But I think finding people who know what they're doing and going along with them is a pretty good strategy in itself.
And, to clarify, I mentioned, set aside that $1 million to invest in syndications. I have a 10, 20, 30-year time horizon for that money to continue to reinvest and to continue to build it. And that's going to ride some ups and downs through the market. So I've learned very quickly now to be patient, and some of the things that can go wrong will go wrong. And this is not a risk-free investment. It's like anything else: discipline, time, don't overextend yourself. Like, those are some of the key things that I've learned moving forward.
Well, that was going to be my last question, is what were some key things you've learned? And you nailed it with those last ones. So, Mark, thank you so much for sharing your story. These kind of stories are so helpful to others who are just getting started or in the middle of their journey, just to hear what others are doing and understand that, hey, yes, this is something that we can do, and it makes sense to work together and find other people to help you out through it. So thank you so much, Mark, for being on the show.
You're welcome, Jim. Thank you for having me.